All right. Welcome to the third lecture of Management 202. Right. So in this lecture, we're going to continue talking about capital budgeting, and instead of focusing on where we come from with the cash flows, we're going to talk about some rules that we use to determine whether we should take a project or not. Okay. So in this slides, I'm going to talk about one, two, three, four, five rules. Okay, five rules that we're going to use to determine whether we should take a project or not. Right. Just a quick recap on what we have done previously. Right. So in the first part of capital budgeting, right, we have already discussed how to come up with an estimate for free cash flows, which we use to calculate the net present value of a project, right? And net present value is also one of the rules that we're going to see in this lecture that we can use to help us make the decision, right? So it is very simple, right? So if we have a project that has a positive net present value, right, then it's a good one to take, right? If it has a negative one, then reasonably we should not take the project. Okay, so we also talk about some finance accounting basics, right? So we talk about what's in the financial reports, and the capital budgeting process is very similar with one of the financial statements, right? Remember which one? The income statement, right? Very similar with that, right? And we talk also we highlighted a couple different concepts, right? For example, depreciation, right? We talk about straight line depreciation and accelerated depreciation methods, right? Companies can use for their accounting. And also we talk a little bit about tax, right? Meaning that you should know where the effective tax rates come from for the capital budgeting process, right? It's very different in the real case, but that's something that we use to estimate our tax payment, right, in capital budgeting. Okay, so now we will start talking about the rules that we're going to need to make for our investment projects, right? So first of all, right, this is the outline of this slide, right? So we're gonna describe the rules in different scenarios, right? So particularly in three scenarios, right? So in the first scenario, right, it's the easiest ones, right? So if we face an investment project or investment opportunity, right, should we take it or not, right? If we have just one project in front of us, right? Then there are three rules that we're going to talk about to help us determine whether we should take it or not, right? The first one, net present value, right? And the second one is called internal rate of return, or IRR, okay? And then there's a modified version of IRR, which we call MIRR, right? We'll talk about what they are and how we use them. And the third rule is called a payback period rule, which is the simplest of the three, okay? And basically, it is a rule that are that are determined by the number of years the investor wants to get the initial investment back. Okay, so let's say you open a coffee shop that takes $50,000 for you to open. Okay, you buy the equipment, you rent a space for whatever reason, right? That's your initial cost. And for you, well, you think that you're comfortable with the project if it can return all your money back within 3 years, right? Then basically 3 years is the payback period for a project, and depending on the cash flow of the projects, right? So if your 3 years of free cash flows can accumulate and pay you back your initial payment in your initial investment of $50,000, then by this rule you will take the project, right? And if in 3 years you cannot collect all your initial investment back, then basically you reject the project, right? So this is a simple description of the project, right? We will talk about examples and also talk about the advantage and disadvantage of these rules, right? And the second scenario is a little bit more complicated, meaning that we're facing multiple projects, and particularly a multiple project that has different that we cannot take all together. Okay, so if we can only take one out of many, how do we decide which one to take, right? So those projects are what we call mutually exclusive projects, meaning that if you take A, you cannot take B, right? And vice versa, right? So here we also have, two rules to think about or to talk about. However, we're going to focus on net present value rule, right? Because for IRR rule, in some cases, it will not work as well as net present value rule. Okay, and finally, we're going to talk about another scenario where we have limited resources, right? So think about resources like capital, right? Like funding, like number of employees, right? Labor, right? Think about it as land, right? Where we can only build so much stuff for our business, right? And then we will use something called profitability index or PI, right? And we will talk about examples for that rule also. Okay, so in the first scenario, right, very straightforward, whether to take a project, right? Just one project to take it or not. And then here are the three rules. The first rule is net present value, right? We already talked about this when we did the first part of capital budgeting, right? So whenever it's positive, you take it. Whenever it's negative, you reject it, right? And here are two ways, right? You can think about net present value, right? So the first way you think about it, right, is the sum of the present value from each piece of cash flow that you're going to receive by taking this project, right? And the second way you can think about net present value is, you can think about this as the total present value of benefits that you receive less the total present value of cost that you're gonna incur, right? That you're gonna see in this project, right? So the difference basically gives you the value for doing this project, right? And if we see a positive value, it means that we should do it. And when we see a negative value, we should not. Then the decision is very easy to make, right? So that's so much of the net present value rule that we're already familiar with, right? So if we have a project that has a cash flow pattern like this, right? So we take an initial investment, right, of $81.6 million, and we're going to receive a $28 million free cash flow for the next 4 years, right? So how do we determine if we want to take this project or not, given a 10% discount rate, right? And this is basically how we calculate this, right? So this is like one piece, right, in the beginning, right, happen right in the beginning, and then annuity for 4 years that pays for 4 years, right? So the total value is a negative 81.6 plus the value for the annuity, which will give you $7.2 million, right, which is a positive number, right? What does that mean? It means that we should take the project, right, under the assumption of 10% discount rate, right? So I'm going to show you why I highlight this part, because a lot of the times the discount rate is the one that's the most difficult to pin down, right? And also the one that's likely to change over time, right? So here, right, highlight the assumption of discount rate over here, right? You're going to see more of the discussion on this later, right? So this is how we do work for a net present value, right? So take a minute, right, to do this problem yourself, right? You own a piece of land near UCR. You're considering to open a bar that costs this much and will generate this much for 10 years, right? So how would you make a decision of whether to open this bar using this piece of land or not, right? And you can do it in two ways, right? So the first way is very similar with what we have just done, right? The only difference is that, after 10 years, you can sell it to some other people for a residual value or for a terminal value, right? So you not only need to account for the initial investment, but also need to account for the last payment, right? Which sort of makes this cash flow pattern like a bond, right? Like a bond. All right, so you can use the pricing formula in Excel for the bond, right? With both periodic payments and a residual payment. And of course, don't forget, adjust for the initial investment that you have to pay for this bar right in the beginning, right? And you know, after you calculate the number, you can easily tell whether you should invest or not in this project. Okay, so feel free to take 1 minute, right, to do it using the regular formula, or right, to do it in the Excel. Okay, so that's the NPV rule, very straightforward, right? We're, you know, very familiar with the process already. So the number 2 rule is probably something that you have not seen before, right? This is called internal rate of return rule, or IRR. Okay, so how do we understand this rule, right? What does internal rate of return mean, right? So think about a cash flow pattern like this, right? Which is what we have seen in the, you know, previous 2 slides, right? So if we have a project that has the same cash flow pattern like this, right, then what we are going to do to calculate net present value is to first make an assumption on discount rate, right? And hopefully this discount rate is constant all over time, right? And then we apply this formula to calculate the net present value, right? So if R over here equals to 10%, we will reach you know, something like a $7.2 million, right? If you remember in the previous 2 slides, right? So if R equals to 10%, which is our assumption for discount rate, net present value is 7.2, right? So what if R is higher than 10%, right? Or what if R is lower than 10%, right? So what if we don't have quite good clue on how much our assumption of discount rate should be, right? So in this case, right, the internal rate of return rule gives us, you know, a break-even point for our assumption of discount rate. Okay, why is this a break-even point, right? So the internal rate of return is basically defined as the discount rate that sets the net present value equals to 0. Okay, so if you set this equation above, net present value equals to this, the sum of these 5 numbers equals to 0, then we can solve this function, right? This basically becomes a function of R, right? And we can solve this function and figure out what R is, right? And figure out what R is, right? So some of you might worry that, you know, we have a degree of 4 over here. Doesn't that mean that we could end up with, you know, multiple solutions for R? The answer here is no. Okay, the answer here is no, because this equation, right, this side of the right-hand side of the equation over here, right, this equation is strictly decreasing in R, right? So it basically means that, you know, if you graph it out, this curve will only cross the horizontal axis for once, right? So there will only be one single solution for R in this case, you know, in simple words. Okay, and this R, which is the solution of this equation, if you set it equal to 0, right? If you set it equal to 0, is basically how we define the internal rate of return, right? So in other words, right, this R basically give us the break-even point of where net present value equals to 0, which is basically the thing that we use to determine whether we should take the project or not, right? So in this case, right, think about this. If we have a higher discount rate than internal rate of return, how will that make the net present value? Will it become negative or will it become positive, right? If we have a discount rate which equals to the internal rate of return, then we'll naturally reach NPV equals to 0, right? So here's a question, right? Without going to the next slide, right? Think about this question, right? If we have a discount rate which is higher than the internal rate of return, that potentially makes the net present value smaller, right? So in that case, if we have a discount rate that's higher than the internal rate of return, we should have a negative net present value, right? And vice versa, right? So think about this, right? So let's go to the next slide. Okay, so here, before reading the word on the slides, right, let's take a look at the graph. Okay, let's take a look at the graph. So this graph shows, you know, the relation between net present value and cost of capital. Well, here, right, think about cost of capital as a discount rate, right? So cost of capital here is equivalent with the discount rate over here, right? So this is a graph from the textbook, right? So the way they describe it in the textbook is basically treating the discount rate over here, right? The x-axis, right? And describe it using cost of capital. They're the same thing. Okay, so if we have a discount rate of 10%, right? Of 10%, we're going to reach a net present value of 7.2, right? And if we increase our cost of capital, right, that will essentially make the present value of future cash flows smaller, right? Remember, our future cash flows are $28 million per year for the next 4 years, right? If we have a higher discount rate, it means the present value for this future $28 million will be smaller, right? Because we discount them harder, right? So essentially, it translates into our net present value estimation that we're going to have a decreasing function, right? Decreasing function of net present value in terms of discount rate, meaning that net present value will decrease as the discount rate increases, right? Right? So if net present value decrease when our discount rate increases, then there will be a point where this curve cross the axis, right? The horizontal axis, right? So this point where the line crosses the axis will be our estimation of IRR, right? So remember that the definition of IRR is uh, the discount rate that sets net present value equals to 0, right? So we'll have an IRR over here in this case of around 14%, right? So what does that mean, right? What does that mean, right? So on the left-hand side, the left-hand side and the right-hand side of this IRR basically gives you two different zones which you will make different decisions on this project, right? So basically saying that it basically says that if our estimate of cost of capital is smaller than IRR, we should take the project because it gives us a positive net present value, right? When it is 10%, we have a $7.2 million, right? However, if our estimate of discount rate is higher than 14%, let's say around 17% over here, then we will have a net present value somewhere over here, right? Meaning that we'll have a negative net present value, right? So in this case, we should not take the project, right? So going back to the rule, right? So IRR rule basically gives us a break-even point to make a decision on our project, depending on where our estimate of cost of capital or where our estimate of discount rate lies, right? If it's within the green zone, we take the project. If it's within the red zone, we reject the project. Okay, okay. So the question is this, right? So is this always true, right? Is this always true, right? So let's take another example, right? Let's take a look at another example. Well, let's say we change the cash flow pattern a little bit, right? We're looking at another project, which actually gives us a positive inflow, right? Right in the beginning, and a negative outflow in the future. Well, you might ask the question, right? What kind of business is like this, right? This is sort of like a quite different impression of investment project with what we have in our mind, right? So it's sort of like a counterintuitive type of business, right? So here, think about something that the insurance company does. Okay, so if you are the owner of an insurance company and you sell, let's say, car insurance, right, vehicle insurance, then what happened to your business is that you first receive cash flows from selling the policies, right, and later on there's a probability of traffic accidents, right, for your policy holders, and there will be a likelihood for them to submit their claims for reimbursement on the cost they spent on the traffic accident, right? So this is this project cash flow pattern is similar with what an insurance company would observe, right? So you sell your policies first, right? Receive your positive cash flow in the beginning, and then you pay out money to the policyholders to reimburse their traffic accident cost, right? So this is a quite opposite, right, cash flow pattern to the existing one, right? To the existing one, or to the normal ones, or to the regular ones that we are familiar with, right? So if the cash flow pattern is like this, right? What we'll see is an opposite relationship between net present value and cost of capital. Okay, so in this case, right? So think about this, right? In this case, if we have a higher discount rate, it means that the present value of this negative future payments will be higher if the discount rate is higher, right? Let me pause here for like 5 seconds and think about this, right? So let's say we have a 10% discount rate, right? To then the first period's negative outflow will become negative 500K divided by 1.1, right? If we want to calculate the present value, right? And then if we increase our cost of capital to like say 20%, then the present value of the first piece of cash flow will be negative 500K divided by 1.2, right? So negative K divided by 1.2 is higher or is greater than negative 500 divided by 1.1, right? So it means that a higher discount rate would actually increase, would actually lead to a higher net present value in this case, right? Right? So the relationship between net present value and the discount rate is actually positive, right? Is actually a positive relationship, right? So here we will reach a different sort of different conclusion with the previous example, right? So here, if we have a cost of capital or we have a discount rate that's less than or smaller than IRR, right? We will reject the project because it will give us a negative net present value, okay? So for a 10% cost of capital, we will have a negative 243 net present value, right? However, if we have a higher discount rate, let's say 30% discount rate, right, then we can reach a positive net present value of about $100 million, right? So this is quite different with the previous example, right? With a cash flow that starts with a negative number and followed by the positive number. Right. So this is something that you should keep in mind when you use the IRR rule, right? So first of all, right, you determine the pattern of the cash flow, okay, and then you apply the IRR rule and decide, when we have an estimate of discount rate for, on the left hand side or right hand side of IRR, then which one we should use, right, to determine whether we should reject or whether we should invest, right? And things can get a little bit more complicated, right? When we have a more difficult cash flow pattern for IRR rule. Okay, so let's think about this case, right? So when we not only have negative cash flows in the future, but also have positive cash flows in the future, right? So this essentially makes this, relationship between net present value and discount rate even more complicated, right? Meaning that sometimes, right, the equation will give you multiple solutions for IRRs, right? So in this case, the relation between net present value with discount rate is like a curve, right? So it decreases first and then increases, right? So basically it means that, for a discount rate less than this solution, the first solution of IRR, which is 5.79%, on the left-hand side of this, we take the project, right? Between the first solution and the second solution, right, we take the project if we have a cost of capital or if we have a discount rate lies within the range of 5.79 and 13.8. We reject the project, right? And then if we have IRR, or if we have a discount rate which is higher than the second solution of this IRR, right? Meaning that if we have a discount rate which is higher than 13.8%, falling in the green zone again, we take the project, right? We take the project, right? So this is basically the complicated things about IRR, right? So if IRR is so complicated, why don't we just use discount rate? Or why don't we just use the net present value rule, right? So why would we go through so much trouble to look at the different patterns of cash flows and make a different use of IRR rule, right? So remember, there's always the advantage of using IRR rule in the first place, okay? So here, remember, right? NPV rule require us to know the exact discount rate that we should apply to discount the future cash flows, right? We need to know either 10% or 8% so that we can use the net present value rule to find an estimate, right, for the NPV. However, the IRR rule does not require you to have an exact estimate of discount rate. Okay, so without knowing the discount rate in the first place, we can find the IRR solution, which is 14% right here, right? And if you believe that the discount rate is going to for sure, right, falls on the left hand side of 14%, then no matter what it is, we're going to take the project. Okay, so meaning that you don't need to have an exact estimate of discount rate, right? And same thing happens to the red zone, right? So if you know that for sure we're going to have a cost of capital that's going to be like 17, at least 17%, right? Then no matter how big the cost of capital is, you should not take this project at all, right? So this is the benefit of IR, right? So without making any assumptions, right? Without making any assumptions on cost of capital, we can find the IRR solution, right? Given a fitted cash flow pattern, right? And so here, when things get more complicated, IRR sort of lose this benefit, right? So there's something called modified IRR rule, which you can see in the textbook, right? So essentially, multiple IRR rule, basically a modified IRR rule, basically, manually convert this difficult cash flow pattern, right, into a simple one, which we can directly apply IRR rule, right? So if you look at this pattern of cash flow, right, you will see a -1 in the beginning, +1, and then -1, right? So this basically suggests that we will likely to reach multiple solutions for IRRs, right? Like the curve we have seen before, right? So in this case, the curve is opening towards the downside, right? So we will have two solutions, right? One over here around 10%, one over here around 40%, right? So what modify IRR rule does is that it manually converts, right, all the negative cash flows to the beginning and shift all the positive cash flows to the end, right? So after doing that, we will only end up with two cash flows, right? A sum of negative cash flows in the beginning and a sum of positive cash flows in the end, right? And then if we have only these two pieces of cash flows, then the pattern essentially, changes from this curve, right, from this hump-shaped curve into, a more straight line curve, like in the second graph. Okay, so that's how we apply the modified IRR rule, right? So, however, right, if you want to use a modified IRR rule, you need to have an assumption for the discount rate. Okay, okay. So think about this, right? So if you want to use the IR rule, you have to have a assumption for discount rate, then it basically takes away the benefit of using this IR rule in the first place, right? So remember, the benefit of IRR is that we don't have to need to have an assumption for discount rate. Well, however, if you want to use this MIR rule, you have to do that, right? So this essentially takes away, our initiative to use our rule at all, right? So, and also this will gives you basically the very same conclusion with using net present value rule, right? Meaning that, you will reach the same conclusion using NPV and MIR always, right? So then this becomes essentially an inferior rule for you to use compared with net present value rule, right? Because, it's very simple, right? If both rules assume a discount rate, then why do we need to bother shifting things around, right? We can just use the net present value rule to decide whether the net present value is positive or negative, right? Instead of determining a single solution for IRR, right? So this is why I want to explain what modified IRR is, but do not encourage you to apply it, when we face a difficult cash flow pattern, right? However, we should know, right? We should know whether a cash flow can be directly applied, whether we can directly apply the simple IRR rule to a cash flow or not. Okay, so here are 3 projects with 3 different cash flow patterns, right? So the thing I want you to know is that, even though we know that we don't want to use MRR compared with net present value, right? We want to know when we can directly use IRR because there is this benefit for using IRR, right? And to use that, we need a cash flow pattern which will be either all positive in the future or all negative in the future, right? So basically, we want a cash flow pattern of project A or project C, so we can directly apply the IRR rule. Okay, and for something like project B, right? You have 0 in the beginning, a positive, positive, and then negative, right? So it suggests that most likely you will have multiple solutions for project B, right? For IRRs for project B, right? So in this case, it's not worthwhile to use IRR rule anymore, okay? Because you can just use net present value rule, okay? However, for the first project and the third project, right? Project A and project C, there still is the benefit of applying IRR, right? Basically, without having to have an exact estimate of discount rate. Okay, so for cash flow patterns like A and C, we can directly apply IRR rule, right? However, for project B, it is likely to give multiple solutions. So we would rather not use IRR rule or modified IRR rule in this case. Okay. So I don't require you to understand, right, the process of modified IRR, right? As long as you know that this is a way for us to, change the cash flow pattern so that we can use IRR rule, and that's fine, right? Because, our conclusion with modified IRR rule is that it is inferior or more complicated, but will give the same answer with net present value rule, okay? Okay, the last one is the payback period rule, right? The last one is payback period rule. And remember, the scenario we're facing, right, is, given a project, whether we should take it or not, right? And the payback period rule is a very simple and, a naive way to think about whether we should take a project or not, right? So like the example I've raised right in the beginning, right? If you have a coffee shop and the coffee shop takes, let's say it's a very huge coffee shop, right? It takes $10 million for your initial investment, and it pays you back $4 million, right? For another 4 years, right? So if you are owner of the coffee shop that thinks, well, I'm okay if the project is going to pay me back my initial investment of $10 million in 3 years, I will take the project, okay? Then given this project, should you take it or not? You would take it, right? So if your required payback period is 3 years, right? Then basically, without thinking about time value of money, right? Without thinking about time value of money in this case, the total payments you're going to receive or total cash flow you're going to receive from this project for the first 3 years is $12 million, which is higher than your initial investment, right? So basically, in this case, you will take the project. You would take the project. However, if you require payback period, right? If your required payback period or your desired payback period, whatever word you use, is 4 years. Oh, sorry, it's 2 years, right? So if your required payback period is 2 years, then, right, with only $8 million in total, at the end of the 2 years, right, at the end of the second year, then you should not take the project by this payback period rule, right? So that's basically how simple it is, right? So the rule is very subjective, meaning that different people may have different required payback period for different kind of project, right? However, this is just, how comfortable the owner with, the payback period time, right? So it's, quite different. It can be very different. The decision can be very different depending on, different people's personalities or how quickly the investor required his initial investment back, right? However, there's not much economics underlying this rule, right? And if you want to take, if you want to take time value of money into consideration, you can sort of apply a discount rate on the future payments, right? On the future payments, right? So let's say we have a discount rate, and we're thinking about how many years we can earn back our initial payments, right? So then you can calculate the present value of the payments within your payback period and compare that with your initial outflow, right, to make the decision. Okay, so that's payback period rule, right? It's sort of naive, but it's very simple and intuitive, right? So a lot of people still use this payback period rule as one of the rules to make decisions for their projects. Okay, so this is basically the first scenario, right? When we have only one project, we make the decision on taking it or not to take it, right? And we have three rules, right? Net present value, right? Positive, negative, we take it or reject it, right? And we have IRR rule, which is a little bit more complicated, right? IRR rule requires us to first determine the cash flow pattern, right? And then to make the decision of whether we should take it or not when we make a comparison between our estimate of cost of capital with the solution of the IR, right? And finally, the payback period, right? So the second scenario, right? The second scenario is more realistic, right? So a lot of times investors or companies will face multiple projects. However, they can only choose one of them or maybe two of them, right? So those are what we call a mutually exclusive project, right? If you pick one, you cannot pick the other. So how do we make decisions in this case, right? How do we make decisions in this case? So as a spoiler, right? Right? The net present value rule is the priority, right? Is the prior rule that we should choose, right? When we face mutually exclusive investment opportunities. Okay. We should always use net present value rule as a rule of thumb in this case. Okay. So basically, it tells us that if we have multiple mutually exclusive projects, we calculate the net present value for each of them, and we pick the one with the highest net present value. Okay. So IRR rule can also be used, but sometimes, right, different project will have different scale, meaning that the amount of cash flow, the scale of cash flow are different, right? So project A returns you with a cash flow of $1,000 a year. Project B returns you a cash flow of $10,000 a year, right? And they may have the same IRR, but the net present value of one project could be much higher than the other one, right? So if you have to take one of them, you will of course take the one with the higher net present value, right? So this is basically why it doesn't work under effects of scale, right? And the second one, and there's another thing, right, which is related to the investment horizon of different projects, right? So let's say we have two projects, A and B. A lasts for 3 years and B lasts for 4 years, right? So although we have a higher IRR from a project A, right, because we receive slightly higher net cash flows, right, for project A. But project B gives a longer investment horizon, but maybe the cash flows we receive from project B is smaller. We will end up with a higher net present value for project B than project A, right? So in this case, we also tend to choose, right? We will also tend to choose project B, okay, if we have the same amount of time to take both projects. Okay, so here are some examples, right? So I do not require you to fully understand, right, the detail for each example, right? But these are basically the scenario where the conflicts might arise between the net present value and the IRR rule. Okay, so for example, the first case, right? For the first case, we have two projects. One project gives you both project takes $10,000, right, for initial investment. One returns 5,000, and one returns 6,000, right? So in this case, net present value and IRR rule will give you the same conclusion, right? project B or the second project is better than the first project, right? It has a higher net present value. It has a higher IRR, right? So no matter which rule you use, we should take the second project. However, right, if we have a different scale of cash flows, meaning that let's say we have a project number one, which has a cash flow pattern of negative 10K, 5K in the future, right? And we have a second project that's basically gives you that will basically give you 5 times, right? 5 times the cash flows from the first project, right? It's a bigger project, right? It gives you a bigger cash flow, right? It costs more in the beginning, but also returns more later on, right? So we will have a very different net present value for these two projects, but we will have exactly the same IRR, right? Meaning that the return rate are the same, but we have definitely a higher dollar amount of value from the second project, right? So in this case, we should take the second project because it gives us a higher value, right? And let the first one go. Okay, although they have the same IRR, right? So in terms of timing of cash flows, right? So let's say we have two investment projects. One takes 4 years. The second one takes 2 years, okay? And the first year, right, for the first project, we have an IRR of 23.4% and a net present value of 10,000. And the second one will give you a higher IRR, right? However, a lower net present value, right? So in this case, it will sort of depend on the real scenario of this project, okay? So if there's no preference for the time horizon, right? Meaning that if you are an owner of this business, you don't care about the residual 2 years left, right? You don't have anything to do for this 2 years. Then you probably should take the first project, which lasts for 4 years. Although it gives you a lower IRR, it gives you a higher net present value. Okay. However, if you do treasure the 2 years of time, which can be saved if you take the second project, right? So it has a higher IRR, right, but a lower net present values. So let's say you are thinking about doing something else, which will also give you some value if you take advantage of this 2 years left, right? Then you probably would want to think about taking the second project, right? However, right, if you don't have any plan over here, right, and you don't care about the time horizon, basically saying that you don't care about the time horizon of these two projects, then probably taking the first project is better, right? Then probably taking the first project is better, right? So this is the scenario where you can reach different conclusions using net present value and IRR, right? So depending on your preference on other things like time horizon, like uncertainty in the future, right? Maybe also depending on the natures of different project, right? Is it very easy to convert whatever you have for the second project into a new project, which you can think about doing for the rest of the 2 years, right? Something like that, right? So depending on different preference, you might reach different conclusions, right? You might reach different conclusions. So here, basically, if you don't care about the 2 years left, right, net present value rule is probably going to give you a better answer, right? And so basically, this is what I'm trying to say about mutually exclusive projects, right? And the difference in the conclusions of these two type of rules, right? So depending on the nature of different projects and also the preference of the business owner, right, you might end up with different conclusions using these two rules, right? So it does not mean that one rule is inferior or one rule is useless compared with the other one, right? So both rules might give you some clue on how to think about different project under different circumstances, right? And you will always have the choice to take one instead of the other based on your understanding or based on your preference of the results of these two rules, right? Okay, I think that's a good way to think about different rules and different conclusions arising from different rules, right? So this is basically about the second scenario, right? So we want to choose net present value as a priority rule, right? As a prior rule to think about mutually exclusive projects, right? But sometimes IRR can also be informative, right? So in reality, what do CFOs do? Right. So in reality, what do CFOs do? So I apologize that this is the most updated evidence that I can find. Right. So I think there are other surveys or research that will have a more, updated evidence on what CFOs does. But this is very hard to do. Right. So they're very busy people, and a lot of times they probably don't want to review how they value different projects. Right. So but in this research by Granham and Harvey, I think two professors from Harvard, right? So they have surveyed 400 CFOs and asked them basically what kind of rules they use for valuing future investment, opportunities, right? This is their answers, right? 76 of them use IRR rule, 75 of them use net present value rule, right? So slightly even more people, right, use IRR rule than net present value rule, right? And surprisingly, right, might be surprising to you, right? It is very surprising to me, right? So 57, right, 57% of the CFOs also use payback period rule, right? Although we know that it's not quite quite a scientific rule, right? It's quite subjective, but maybe there's benefit of using it because different CFOs have different preference for different companies, right? So and also around 70 and also a large number of people use those rules altogether. Okay, altogether, meaning that they not only just focus on IRR rule, they also check net present value rule and payback period rule, right? So um, why would they do that, right? Why would they do that, right? Why don't they just use one rule instead of the other, right? So there, you want to know that there are benefits, right, and basically advantage and disadvantage for different rules, right? For net present value rule, right, it is very informative on the total dollar amount, right, for each project, right, and the calculation for net present value rule is also very reliable, right? No matter what the cash flow patterns is, right? So you have negative, you have positive, that's also fine, right? We just discount it to the present and sum it all up, right? But the bad thing about net present value is that you always need to have assumption on the discount rate, and sometimes, right, the error in your estimate for discount rate can largely influence the outcome of your net present value. Okay, right? And there are benefits for IRR too, right? Meaning that if your forecasted cash flow pattern follows the conventional cash flow patterns, right? Meaning all positive or all negative, right? Then IRR rule is very informative on a return of the project, right? On the rate of return for the project, right? Meaning that at the break-even point, if the break-even point is 14%, then having a cost of capital or having a discount rate that's higher than 14% might gives you a very good project, right? Might be a very good project to take, right? It gives a break point for CFOs for their estimates of discount rate, right? And the bad thing for IRR is that there are likely difficult cash flow patterns where you simply just cannot use that rule anymore. Okay. And finally, for payback period rule, right, it is good in the sense that it requires much less or much fewer assumptions, right? However, it is quite subjective, and different people might have a very different required payback period, right? So that's something that you want to consider. Okay, so that's about the first two scenarios, right? First one, right? One project, take it or reject it, right? Second one, facing mutually exclusive projects, right? Which one should we take, right? And here, finally, the last one, right? Which is even more realistic, meaning that now we not only face a group of projects, right? We also face a budget limit, okay? We also face a budget limit, right? Meaning that we have a limited resources for us to use or for us to invest in those projects. Okay, here's an example, right? Here's an example. let's say we face three we face three projects, right? Each of them has a net present value estimate already, okay? And each of them will have initial investment requirement in the third column, right? And now we are, a company with a budget pool of $200 million, okay? $200 million, right? So which ones of the project should we take? Right? Should we take to make the highest amount of profitability for our company? Okay, so in this case, right, we should sort of compare these three projects, right, in a way which we can sort of determine the profitability for each project, right? So how do we determine the profitability, right? So if we define profitability as our income over our outcome, okay, or as our inflows divided by our outflows, right? Then we can sort of have a standard, right? A unique standard for each project, right? So how do we determine the profitability over here, right? So that's what a profitability index is, right? That's what a PI is, right? So I will use the word PI, right, to stand for which stands for profitability index, right? So how do we calculate the PI for each project over here, right? We have a net present value for project A, which can be thought of as an inflow, right? Inflow, and which will take initial investment of $200. That is outflow, right? That is outflow. And so basically, if we calculate the profitability index for this one, right, you actually can have a profitability index which is $100 over $200, right, which is 0.5, right, which is 0.5. And if you calculate the same thing for B, then we will have 7.75 divided by 120, right? And when we have C, we will have 70 divided by 80, right? Divided by 80, right? So this is an interesting example, right? So think about this, right? Some of you may have the question, right? So why would we take a project that has a net present value which is smaller than initial investment, right? So the answer here is that net present value is already accounted for the initial investment, right? So basically, net present value is our profit of this project, right? And we want to calculate PI as our profit divided by or scaled by our initial investment, right? So we will have ABC. We'll have profitability index for ABC, right? And then we want to pick from the top to the bottom, right? Until we exhaust all our budget, right? So if we think of PI in this way, right, which is NPV divided by investment or the amount of resources that we use for each project, then we will have a PI of 0.5 for A, 0.625 for B, and 0.875 for C, right? So which one should we take first? We take C first, right? However, right after we make decision for the first project, you want to take a look at our remaining resources or our remaining budget, right? So remember, we have a budget of $200 million, right? After we take the first one, or after we take the first project, which is C, right? Well, there is going to be a residual of $120 million in our budget pool, right? Which will, exactly allow us to take the second highest project among the three, right, which is project B, right? So we're going to exhaust our $200 million by taking both B and C together, right? Instead of taking project A, which cost all our budget, right? So what's the outcome, right? So what's the outcome, right? The outcome is that we're going to reach 70 plus 75 net present value or profit if we take B and C together, which totals 145, right? Compare with, taking A only, which will only give us, $100 million of net present value, right? So taking B and C together here is definitely a better choice than, spending all the money in project A. Okay, so this is basically how probability index works, right? And here's an example, right? Here's an example, right? Feel free to pause the video here and look at an example on yourself and spend maybe 1 or 2 minutes to calculate the profitability index for this one. Okay, you have 7 projects, right? You know the net present value for each project, and instead of having a budget for money over here, right? We have a budget for our labor, right? Employee headcount, right? There are only a limited number of people that you can assign to different projects, right? So if we want to take multiple of them at the same time, which ones should we pick, right? Which ones should we pick, right? So I assume that you have already paused and did your own work. Now I'm going to show you the solutions. Okay, so the third column basically tells us the profitability index for each project, right? We are going to start, right, of course, from the highest PI, right, which is 0.487, right? 0.487. So we're going to start from the second project, right? We're going to pick the second project first, right? However, here we want to also notice the remaining number of employees that we can use for other projects, right? So one thing we can do is that we start with a total of 190, and we subtract the number of employees that we need to assign to the project that we desire to pick, right, to select. So the first project takes 47 people away, right? And then the second highest PI is which one? The seventh one, right? This one, the last one over here, with the PI of 0.403, right? Which takes 32 people. Then subtract 32, and which leaves us 111, right? So it means that we can still take more projects, right? So which one should we take? There's 355, 354, they're quite similar, right? So let's take the higher one first, which takes away 48 people. And then can we still take more? Right? Can we still take more? Can we still take the first project, which has basically the highest PI among all the projects that are left? Right? Yes, we can, right? So we can take another 50 people off by taking the first project, which will leave us only 3 people, right? Only 3 people. And then we know that we cannot take any more projects, right? We basically exhaust the number of employees, right? So here we took 4 projects starting from, the second one, the last one, the sixth one, and the first one, right? And then this is basically our choices of projects, right? Starting with the highest profitability index. Okay, okay, until we cannot take any more, right? So an interesting thing for the PI rule is, that sometimes you might have a better choice starting not with the highest PI. Okay, so let's take a look at this example, right? Right. Sometimes it's better if we use up all the remaining resources than taking the highest PI. Okay, let's take a look at this example. This is quite interesting. Okay, so let's say a firm is facing 3 investment opportunities. Right, the first one gives a net present value of 3, which requires investment of 1. Right, the second, well, you will calculate a PI as 3/1, right, which is 3. The second one, 2, right? PI equals to 1. Okay, the ratio between 2 and 2. The third one, 2.5, 3, PI equals 0.803, right? So following our PI rule, we should start from picking. We should start with the highest PI, right? Which is the first one, right? Which is the first one. So let's say we have $4 or $4 million, right, as the investment resources, right? So if we start with the first one, which takes $1 away, right, we will have $3 left, right? We'll have $3 left. Then, we can select the second highest PI, which is the second project, right, which takes another $2, right? However, right, think about this. If we spend the rest $3, right, if we only spend $2 of it, right, although this is a higher PI project, we will only have a net present value of 2, right? However, if we use $3 from the third project, we can reach a higher net present value of 2.5, right? Right. So we pick the first one, right? For sure. The question is when should we pick the second one or the third one, right? So following the PI rule, we should pick the second one, which has a higher PI than the third one. But we can also pick a third one, right, which will give us a higher net present value than the first one, right? So this is sort of like a pitfall of the PI rule, right? Meaning that sometimes when you select the last project that you can take, and you sometimes want to go for the one with a higher net present value, although it has somehow a lower PI, right? So basically in this case, right? So by choosing the third project, by choosing project C, we can use up all the remaining resources, which is $3, right? After we take the first one, right? Which will give us a higher net present value if we pick the second one and have $1 left. Okay, so this is by the assumption that we don't have any use for the $1 left, right? These are basically all the project that we can take with that money. So in this case, right, we will prefer to take the third one than the second one, because the third one, although with a smaller PI, it will give us a higher net present value. Okay, so be very careful with the last project you're going to take. Okay, sometimes the conclusion can be different from the original probability index rule, right? So in this case, it's same, right? And in the first example, this is also the same with the original PI rule, right? However, in the last example, right, some strange things can happen, and be very careful with this. Okay, so we take A and C. All right, so here's a summary, right, for different rules, right? I'm going to leave this to you to look at the advantage and disadvantage of different rules. Okay, so basically this is about the investment rules that I want to talk about, right, for this class, right, for the capital budgeting part, right? And essentially, first of all, we know how to get cash flows. Second of all, we know which rules to apply to make the decisions, right? This is basically the main part of capital budgeting, right? The main part of capital budgeting. And there's one more slide of capital budgeting, which is about real options. Okay, so here, real options, think of real options. What are real options, right? Basically, I think I've explained in the previous lectures, right? So real options are basically the flexibilities, okay? The flexibilities that are, sometimes, inherited in different projects, okay? So what are some examples of real options, right? So here's a video, right, by a professor on YouTube. You can watch, you can get some more detail on, the understanding of real options, right? But in simple words, right? Think about two mutually exclusive projects with the same net present value. Okay, so basically saying that if we use whatever rules, they will give us the same conclusion. Okay, they will give us the same conclusion, right? So they are equal, they're equivalent, right? So they will give us equal net present value, equal IRR, no matter which rule we use. Okay, so one project is a residential area and the other one is a shopping mall. Okay, basically how to use a land, right? We have a piece of land. We're thinking about whether we want to build a residential area or a shopping mall. Okay, so the shopping mall requires, the residential area requires more work on the construction, right? Both for building it up and tearing it down. Okay, however, the shopping mall, right? If you think about a shopping mall, it's just like a huge, a huge building, right? If you think about Costco, it looks like a huge storage, right? Storage room, right? Storage building, which is very easy to tear down and restart a new project on it, right? So this is basically the different stuff, right? Or an example of real options that are inherited in different type of projects, right? Because the nature of the project are different. Okay, so if we know that the area is expanding very quickly, right? Meaning that we see an increasing population coming in this area, right? The area is getting more and more popular, right? Which also brings more opportunities for the use of this piece of land in the future, right? Which project would you prefer to take, right? If you expect the land be more valuable in the future, right, for other use, right? So think about, let's say, I don't know, like Irvine, right? Like Irvine. Um, a lot of companies want to go there because the environment is good, right? Because the weather is nice, um, and Irvine 50 years ago and Irvine right now are quite different, right? So if you are looking at Irvine 50 years ago, and you own a piece of land, which one would you think about building up, right? A residential area or a shopping mall, right? So you would probably prefer a shopping mall. Okay, you would probably prefer a shopping mall, assuming that these two projects will give you the same net present value. Okay, so I know the land will also appraise higher if you want to sell it to other people, right? Let's assume the net present value is the same, right? So if we want to think about the flexibility of changing the use of this piece of land, then we would probably prefer shopping mall than a residential area, right? Which takes more work to tear down and build up, right? So this is basically the value of a real option, right? It is, sometimes it's inherited in different projects, and sometimes it's very valuable, right? It's something that you really should take into consideration when you decide which project to take. Okay, so think about those as a flexibility of a project, right? So if you think about this in this way, right, although it's very hard to value the flexibility a lot of times, right, the total value of the project that you're going to take should be the sum of the net present value that we can expect it, right, that we can expect from the future, plus the incremental value of real options, right, meaning basically plus the value of these flexibilities. Okay, so here are some examples, right? So there's this option to delay. Okay, for a certain project, you can pause it without having to spend a lot of money. Okay, so for example, there's this shale oil production. Okay, the production cost is very high for shale oils, right? So when the oil price is very low, it's not worthwhile to engage in shale oil production. Okay, and a good project, right? And a good project is to allow you to pause the shale oil production and engage in less expensive oil productions, right? So a technology like a shale oil production has this real value, right? Has this value in the real option, right? Also sometimes, right, especially right given this COVID situation, right, a lot of movies may have made its calendar or may have planned to launch in theater, but sometimes, right, because we cannot go to theaters anymore, right, particularly right now, then it will be a valuable real option, right, if the movie manufacturer or the movie production company can delay the release of this movie into the theater, right? So let's say, well, the movie is expected to come in the theater in March of 2021, right? Because of the COVID situation and the vaccines coming in, right? So if the production company can delay it to, let's say, sometime in September, right? Maybe it will be much better for the company, right? The revenue from the theater may be much higher, right? Then the option to delay, right, to put on a movie in the theater is very valuable for the project, right? And also sometimes there are blockbusters like Avengers, right? If you are other movie producers, you do not want your movie to come on the theater at the same time with Avengers, right? Because no one will go to see your movies, right? And sometimes you will find this strategy used in the release videos of the movies, right? In the commercials of the movies, right? So sometimes it will announce a specific date. Sometimes it will just say 2021, 2022, right? Without announcing a very specific date, right? So that gives you the flexibility to change it, which could be very valuable. And there's options to expand your investment. There's options to abandon your investment, uh, or to abandon your project without having much value, right? So think about software maintenance, right? So if you're designing a game, then it's very easy to stop without having spent too much money on it, right? And think about the option to expand, right? So if you are, a company like Uber, right? You initially, your business is, basically shifting people around, right? Transporting people. Then if you have established this business, then it will become also very easy for you to transport food around, right? That's where Uber Eats comes in, right? So the value, right, or the value for the real option for Uber itself, is very valuable for its future businesses like Uber Eats, right, which is already what's happening right now. Okay, and there's always this, other certain options, right? You want to think about. And compare across different projects, right? So the bottom line is greater flexibility increase the value of the project, right? And this is a summary of what we have talked about in capital budgeting, right? So first of all, it's forecasting into the future, right? Not recording like what happens on the financial statements, right? And we want to isolate our valuation of investment project from our financing decisions, right? We don't care where the money comes from. Let's assume we use the company's own cash or own equity to finance the project, right? And we talk about how we start from revenue to calculate cash flows, right? And then we talk about how to make decisions facing multiple projects. And then finally, real options are quite important, right? As the flexibility of different projects, which could also a lot of times add much value to project, right? To the decision making of investment project, right? And now, knowing all this, you're basically an expert in capital budgeting. Okay, so here, this concludes our lecture today, right? And we'll talk about some examples, right, for capital budgeting for investment rules, and a lot of them relates to how we should apply different rules for different projects. Okay, so thanks for watching, and I'll see you in the live class.